So welcome back to Financial Accounting. And in this little mini lecture here, we're going to review the answers to exam number 2. First of all, with regard to scoring, there were 20 multiple choice questions, and each multiple choice question was worth 3 points. So the maximum you could have gotten from the multiple choice was 60 points. So you'll see a little calculation on your screen, on your exam paper, rather, on the first page. The number of questions correct multiplied by 3, and that gives you your score. Each of the little exercises or problems were worth 10 points. So if you got them fully correct, you got the 10 points. If you got them mostly correct, you got the 7 points. If you made an earnest attempt and demonstrated some knowledge of the subject matter, you generally got 5 points. And if you didn't do anything, then I couldn't give you any points. But I think most of you at least made some partial attempt on those. So to get your grade, again, it's 3 points for each multiple choice question and a maximum of 10 points for each of the short little problems or exercises. So let's just go through each one of them in the order they appear. An enterprise which sells goods to consumers is known as a retailer. Proprietorship corporation, service firm. Proprietorship and corporation, those are just two different types of business organizations. Service firm provides a service, not a product. So definition of someone who sells goods to consumers is known as a retailer. Another appropriate response there could have been merchandiser. Number 2, the journal entry to record the return of merchandise purchased on account under a perpetual inventory system. Remember, a perpetual inventory system, any increases to inventory are debits to inventory, any reductions to inventory are credits to inventory. So here, if it was a return of merchandise that was purchased on account, the full entry would have been a debit to accounts payable and a credit to inventory. So the answer there is D. As I've suggested before, anytime they ask you a question about the journal entry, it's good to record the journal entry first, then compare your journal entry to the choices given. Number 3, a credit sale for $4,000 is made on April 25th, terms 2/3/10 net 30, which means if you pay within 10 days, you can take a 3% discount, on which a return of $300 is granted on April 28th. So originally they owed you $4,000, that is now reduced by $300, so they now owe you $3,700. And what is the amount to be received on May 4th? So that is within the 10-day discount period. So the amount that you would receive would be the $3,700 less 3% of 37, which is 111. So 37 minus 111 gives you 3,589. Another way you could have done that is take 4,000 minus 300, which is 37, and multiply by 97%. Either way, you get 3,589. Number 4, a merchandising company using a perpetual inventory system will make. It has to do with the adjusting entries. And when you have a perpetual inventory system, the adjusting entries are the same as they would be under a periodic system. However, there is one additional adjusting entry, and that is the adjusting entry you make to correct the balance in ending inventory. So in theory, all transactions that increase inventory under perpetual inventory system would increase inventory. Any transactions that would reduce it would be credited. However, there are mistakes that are made with the inventory. There is theft and so forth. So even if you have a perpetual inventory, you do have to do a physical count of the inventory at the end of the period. So the one additional entry that you have under the perpetual system is to adjust the inventory to actually record what's actually on hand as opposed to what's supposed to be on hand with a perpetual system. So the answer there is B. Number 5, in the balance sheet, inventory is reported. So inventory is a current asset, but you got to list the assets in order of liquidity, and inventory would generally follow after cash, and it would follow after accounts receivable. So inventory is less liquid than accounts receivable, but is more liquid than prepaid expenses. So the answer there is A as in apple. Number 6, inventory's effects. Well, the value of your ending inventory is going to affect the balance sheet. It's going to affect the income statement. So it's going to affect both of them because inventory will be on the balance sheet And remember, the cost of goods sold calculation is beginning inventory plus purchases gives you goods available. And of those goods available, the ending inventory amount is going to go, whatever you got in the ending inventory amount will go on the balance sheet. And the difference between goods available and the ending inventory is going to go on the income statement as cost of goods sold. So the answer there is C, as in cat. Number 7, in a period of rising costs, FIFO. So if costs are rising, you're going to put your most recent costs on the balance sheet. So your older costs are going to end up in cost of goods sold. So as a result of that, your cost of goods sold under FIFO would be lower than it would be under LIFO. LIFO during times of rising costs will give you the higher cost of goods sold. For the lower cost of goods sold, it would be FIFO is going to give you the lower cost of goods sold. Remember, FIFO puts your lowest, gives your most recent cost on the balance sheet and puts your oldest possible costs on the income statement. So if costs are actually increasing, you're going to end up with lower cost of goods sold under FIFO than you would under LIFO. So the correct answer there is B. Number 8, inventoriable costs include all of the following except freight costs are included in the cost of inventory, cost of beginning inventory, goods purchased, those are all going to have an effect on inventory costs. Remember, the cost of goods sold formula is beginning inventory plus purchases gives you goods available, minus ending inventory gives you cost of goods sold. The ones that would not be included there would be B, cost of purchasing and warehousing departments. Number 9, if the beginning inventory is understated by 15,000, again, this has to do with the cost of goods sold calculation. Beginning inventory plus purchases gives me goods available, minus ending inventory gives you cost of goods sold. So if the beginning inventory is understated by 15,000, that's going to understate your cost of goods sold. And if your cost of goods sold is understated, then your net income is going to be overstated. Number 10, the lower a cost of or net realizable value of inventories is an example of the doctrine of conservatism. Conservatism means you always anticipate all losses, postpone the recognition of any gains. So the fact that we're recognizing the decline in an inventory value before the inventory is actually sold is related to the doctrine of conservatism, which is C. 11, which of the following is not one of the main factors that contribute to fraudulent activity? Well, this has to do with the fraud triangle. So remember, that was the combination of opportunity, financial pressure, and rationalization. So incompatible duties, that's when you violate a lack of segregation of duties. But that is not one of the main factors that contribute. The fraud triangle is opportunity, financial pressure, and rationalization. So the one that does not belong there is B. Number 12, all of the following requirements about internal controls enacted under Sarbanes-Oxley, except, so remember, Sarbanes-Oxley was instituted after the Enron big business fraud. So independent auditors must attest to the level of internal control. Companies have to develop the sound internal controls. Companies must continually assess the functionality of internal controls. The one thing that Sarbanes-Oxley doesn't have on that list is independent outside auditors must eliminate redundant internal controls. The auditors don't do that. That would be something for the company to do if they had internal controls they didn't need. So the one that doesn't belong there is D. Excuse me. The use of remittance advice from mail receipts, that's an example of documentation procedures. So whenever we have source documents and internal control documents, it's all part of the documentation procedure. So if we have remittance advice from mail receipts, someone puts down and actually enters, someone other than who records the receipts actually enters the receipts and summarize them. A remittance advice is that would be a documentation procedure. So the answer there is 13A. A bank statement allows the depositors to know the financial position of the bank. And we'd have to look at the bank's financial statement for that. Is a credit letter written by the depositor's bank? No. Is a bill from the bank for services rendered? No. All a bank statement is, it shows what activity either increased or decreased the depositor's account balance. So the answer there is D. Number 5. Which cash is reported on the balance sheet as a current asset? It consists of each of the following except. So checks, money orders would be considered part of cash. Restricted cash, remember, that's cash that is restricted. I told you the story of the money that had been raised for the handicapped accessibility ramp at the church as an example. So that cash which is restricted for a particular purpose is not reported on the balance sheet as a current asset. It's cash. It would be an asset, but it wouldn't be part of cash in the current asset section. Number 16. Interest is normally associated with accounts with notes receivable. So remember, sometimes you could have an accounts receivable that gets turned into a notes receivable. But a difference here is accounts receivable, you're going to have terms where they can pay a certain discount. They pay within a certain period. You're expected to pay the full amount as of a certain period of time. But notes receivable actually has a definite due date, and it normally has interest associated with it. So the answer there is B. 17, again, I'd recommend you put down an entry here. When the allowance method for recognizing bad debts expense is used, the entry to recognize the expense. So if you're using the allowance method, when you recognize the expense, you actually recognize the expense of the account proving to be uncollectible before the individual account is uncollectible. So you make an adjusting entry, debiting bad debts expense and crediting the allowance for doubtful accounts. That's the entry. Debit bad debts, credit allowance for doubtful accounts. Allowance for doubtful accounts is a contra asset to accounts receivable. So you'll show the accounts receivable on the balance sheet. Accounts receivable less the allowance. So if you increase the allowance for doubtful accounts, you are therefore reducing the current assets because you're going to subtract the allowance from the accounts receivable. So the answer there is B. Increasing the allowance actually reduces the current assets. Excuse me. Direct write-off. Under the direct write-off method, when an individual account proves to be uncollectible, you simply debit bad debts expense and credit accounts receivable. So the direct write-off method is not acceptable for financial statement purposes, doesn't debit the allowance. You don't use the allowance under the direct write-off. And D, you don't estimate the bad debt losses. You actually recognize the bad debt losses as they occur. So it actually, the answer there is C, shows actual losses from the uncollectible accounts receivable. Number 19, the two parties to a promissory note are the maker and the payee. So the maker is the person who promises to pay the money. The payee is the person who it's paid to. And number 20, what is the accounts receivable turnover? Accounts receivable turnover is credit sales, which in this case is 1,300,000, divided by the average accounts receivable. So the average accounts receivable, if you take 185 and 140 and divide them by 2, you get 162,500. So to get the actual turnover, therefore, it would be 1,300,000 divided by 162,500, and that gives you 8. So the answer there is C. So again, 3 points on each multiple choice question. Now, with regard to the problems, the first one, you had to do a multiple step income statement. Prepare a multiple step income statement. So a multiple step income statement shows sales minus cost of goods sold gives you gross profit. From that, you have to subtract out the operating expenses, and that's going to give you something called income from operations. So sales minus cost of goods sold gives us gross profit. Subtract out the operating expenses. There's your income from operations. Then you have to list other revenues, which would be a dividend revenue in this case. And you have to subtract out the other expenses and any losses that you have. So that would be casualty loss from vandalism, and interest expense would be other non-operating expenses and losses. So you come up with net income of 235. So to get full credit on this, you had to show all the components, and you had to show the components in that order. A number of you got confused. You thought that dividend income ought to be up at the top. Some of you combined cost of goods sold with the other operating expenses. It's important on the multiple step income statement that you show net sales minus cost of goods sold. That gross profit is a key number. So subtract the operating expenses from gross profit. That gives you the income from operations. And all these other things below income from operations, those are other items of revenue and expense or gains or loss that are part of net income, but they are not directly related to operations. So to get full credit, you needed to have something that looked like that. Next one. It's important to see that we're using LIFO inventory method. So LIFO inventory method means that your inventory is made up of your oldest possible costs. So your oldest possible cost in this case would be 100 units at $3.35. But the ending inventory is for 250 units. So to get the ending inventory, it's 100 units at $3.35, because you only have 100 units at that price. Then you need to get another 150 units at $3.50. So there's your ending inventory of 860. And as far as the goods that were sold, you could have gotten the goods available for sale. Add up all these things: 100 times 335, 450 times 350, 350 times 370. That would have given you an amount. And if you subtract 860 from that, you get cost of goods sold of 2,345. Alternatively, what you could have done is you could have said, okay, I took 150 units here. So what you would do here is your cost of goods sold would simply be the total of the units that were actually sold. So you had at $3.70, you would have sold all of those, and you would have sold 300 of these units at $3.50. So you could have calculated this in a number of different ways. The key thing was to get the ending inventory right. And once you got the ending inventory right, then you can come up with the cost of goods sold. So regardless of how you got there, to get full credit for this, you had to show that the ending inventory was 860, and you had to show that cost of goods sold was 2,435. Mistakes that were made here: some of you got LIFO confused with FIFO. Under FIFO, your inventory would have been made up of your most recent cost, which would have been 70. But remember, you're using LIFO, so your ending inventory is made up of your oldest cost. So that was a common mistake that was made there, getting those things confused. All right, 23. Most of you did pretty well on this. You had to do a bank reconciliation here. So when you do a bank reconciliation, you got to reconcile the general ledger to the bank statement. So in the general ledger, the information related to the account and the ledger is as follows. So you're doing the bank reconciliation, prepare a bank reconciliation as of September 30th. So your bank balance as of September, your balance per your books at the end of September 30th is 22,200, which is your number down here. And the balance per the bank statement, the bank statement shows a balance of 24,365. So a number of you got confused. You didn't show the correct beginning balances. So here's the balance per the bank statement, 24,365 up here. And here's the balance per the books, 22,200. So what you needed to do is you needed to reconcile these. So if you take a look on the balance per the bank, you've got to add to that the deposits in transit, and you have to subtract out the outstanding checks. Deposits in transit are deposits we've made that haven't yet made it their way to the bank. And outstanding checks would be checks that we wrote that have not yet cleared. So those have, so it's the balance per the bank statement plus the deposits in transit minus the outstanding checks gives you 25,674. But you're not done. You got to reconcile that now to the balance per the books. So you had 22,200 per your general ledger. The bank collected a note on your behalf, and they collected also $28 worth of interest. So you got these total here for 4,278. And the bank subtracted out a non-sufficient check and safe deposited box rent of 75. So there's your adjusted balance. I didn't ask you to do it, but if I had asked for the entries necessary here, all those entries that were adjustments for your book would have had to been an adjustment to cash. You would have had to increase cash for the collection of the note receivable and the interests. So you would have had to increase cash 278 here. And then you would have had to reduce cash by 804 here from the bounce check and also from the safe deposit rent. And the last one here, so compute bad debts expense. So you didn't have to do the full entry, although some of you did the full entry, which was great. All you had to do was come up with the compute the bad debts expense. So if you take 8% times 160,000, or whatever that number is, 160,000 times 8%, you've got a credit balance in the account of 980. So your bad debts expense is not 160,000 times 8%. It's 160,000 times 8% minus the credit balance of 980. So your bad debts expense there is 11,200. And then the last one here, B, they estimate that 10% of the accounts receivable will prove to be uncollectible. So you take 10% of 160,000, which is 16,000, but you had a debit balance in the allowance for doubtful accounts. So the amount of the bad debts expense actually is not 16,000, it's 16,400. Okay, so that concludes the review there. I would say overall, the results were what they were, and some of you did great, and some of you continued to struggle. I did notice a pattern here where people generally did better on the little exercises, and I attribute that to the fact that we go over those in class. It was one of the things you suggested after the first exam, give you more opportunity to go over problems in class. So when we go over a problem in class, I would encourage you to, as I make my rounds, to ask questions. And as far as doing better on the multiple choice, I would encourage you to do the little flashcards. In addition to the homework, do the little flashcards at the back of each chapter as well. Get some practice with the multiple choice, because I can only give you like one problem from each chapter. And then the rest of the learning objectives, I got to test through the multiple choice format. So practice will help you with those. Also doing the discussion question, the multiple choice questions at the back of each chapter will help you. And of course, asking questions in class. Okay, so I hope you found that useful. And if you still have any questions about this, then please ask them in class on Thursday. Have a great evening, everybody. Thanks for listening. Bye-bye.